Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwi Bank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
All right, kia ora koutou and welcome to another episode of Markets, Mystics and Mayhem. And this week we're talking inflation. We're going to talk about all the prices that are rising and falling in the Kiwi economy. Households are doing it tough. There's been quite a spike in food prices, energy prices, council rates, insurance premiums. Bloody hell, that's a lot of inflation.
Yeah.
And in the hot seat this week, we have MJV. MJV was in the lockup and went through the data with a fine-tooth comb, and she wrote up our report on inflation. So why don't we kick off? And I want to know what's happening with inflation right now.
Yeah, you're right. Inflation is hurting. That headline rate lifted to 2.7% from 2.5%. We weren't really surprised by this, though, because all of the data really has been showing this re-acceleration in imported inflation. So I think context is really key for, understanding this lift in inflation we're seeing. It's largely driven by what's happening overseas. We used to be importing deflation. Now we're actually importing some inflation from overseas. So there's been a lift in tradables, which is what we call it, to 1.4% from 0.3% year on year. But if you look at domestic inflation, that just continues to cool. So rents are falling. There are still some frustrations around, as you're saying, council rates, those administered costs. Those are still quite hot. But on the whole, domestic inflation is falling because of how weak our economy is.
So tradables inflation, that's the stuff we import.
Yep.
What has risen in that basket?
Largely food. Food prices up 4.2% on the year. We've had vegetables alone, I think, lifted 10% on the quarter. So it's some pretty expensive vegetables, cucumbers and all those things. That was quite chunky. It's a seasonal lift, though. You typically see a rise in food prices around this time, especially fresh produce. We've also had quite elevated prices for meat and dairy, just reflecting global commodity prices being higher as well. So those things, we've seen a spike, and that's really lifted annual rates.
I have to say I'm definitely feeling it at the supermarket. Like I walk through the fruit and veg aisle and I'm like, nope, keep walking. And it's hard because it's something that we encounter sort of on a week-to-week basis. It's very front of mind. I think a lot of people are really focusing on this lift in inflation, and it's quite noticeable for households. So at the end of the day, though, looking at some of the more underlying measures of inflation, which is, what the Reserve Bank's really focusing on, that's still looking a bit better, right? So we're seeing a bit of a cooling in core measures. And then outside, going to the domestic picture, maybe we should focus on that now. We've talked about that lift in your tradables, but it's domestic inflation that the Reserve Bank's focusing on. And it's a bit mixed still, right? Because you've got these administrative costs that are still pretty high and stubborn, but actually everything that's quite, interest sensitive is actually coming out pretty weak. Things like the construction costs were one of them, right?
Yeah, construction was really weak over the quarter. Construction costs actually fell 0.1%. That's the first decline since 2011. On the year, construction costs are up 0.8%, which is the weakest we've seen since the GFC. So there's been, as you're saying, those interest rate sensitive sectors or items within the CPI basket have really cooled off because of how high interest rates have been. It's really, our housing market's been very quiet. There's been no activity in terms of building. So that's really been cooling and really seen prices react to that.
So within that, we've seen the price of materials come off. I mean, we've heard this anecdotally, right? The price of steel, price of jib, price of this, price of that has come off quite a bit after a massive shock higher, right, over 2021.
Yeah.
And now you're saying that potentially labour costs and other bits of it slowing down because of the housing market.
Yeah. This time around, there was a question during the lockup about what's driving the weakness in the construction prices and construction costs. And it's because of things like materials being much weaker, fitting costs, which you were saying is kind of related to labour and services. That's come off as well, and that's the reason why things have been quite soft in the area. We've seen, so the growth in prices in construction has really cooled off, but in terms of levels, it is still high compared to pre-COVID. So that may be the reason why building activity is still quite soft. We haven't quite returned to pre-COVID levels.
But potentially going to start seeing some deflation in that space, because we also saw in the quarterly survey of business opinion a couple of weeks ago that, there were all firms, I think there was a net some 30%, 35% of builders actually looking to reduce prices over the coming quarter as well. And that just really reflects, how tough it is right now. I think you mentioned there was some anecdotes in the report about just dropping prices to become more competitive.
Yeah, it was that was another reason. It's just matching competitive prices. Yeah.
I was talking to some developers and one of them turned to me and said, actually, now's the time to build. Like, if you're wanting to build, now's the time, because material costs are obviously coming off, which is the one big thing, but it's more around the trades. And he was saying, I've got my choice of trades at the moment. I can get any plumber, electrician, whatever, because they're free at the moment, right? They're not back to back for the next 2 years. They might have 3 to 6 months work on at the moment if they're lucky. So, that I think speaks to not just a weak housing market, but softening labour market, an economy which still struggling to come out of this recession, right?
Yeah, reflective of that weak economy is that services inflation. I think it ticked a little bit higher over the quarter, but just that trend is very much going south. And that's when you've got a weak labour market, that should flow through to weaker wages, which is what we're seeing. And services is obviously going to follow in that direction as well. And that's what we're seeing.
Where's services inflation running at the moment?
I think it's around mid-4s.
Down from
it was
high
like
6s.
It was quite high. And it had been quite elevated for a while, but we've seen that trend develop there.
Yeah, I remember, it wasn't that long ago, we were saying, look at the goods inflation, and then we were like, well, look at the services inflation. It's nice that that's heading in the right direction, right? We've almost stamped out a lot of the good stuff, and the services stuff is coming off as well.
Yeah, this is what makes it a little bit frustrating is that if you look at non-tradable, so domestic inflation, that's fallen to 3.7%, the lowest it's been. It's fallen below 4% for the first time in 4 years. That's far from its peak of 6.8% in 2023. Yeah. So we're seeing this fall in domestic inflation. It's just a lot slower than you'd think with such a large output gap because of these administered costs being so high. Council rates 12.2% up. Insurance is up 8%. Electricity, which is not good, just heading into the winter period. Yeah. That's up 9% on the year. Yeah. And so those things are keeping domestic inflation quite elevated, those things are kind of outside the Reserve Bank's control.
Exactly.
Just on those administrative prices, particularly the council rates, I know that they kind of only get refreshed or relooked at once a year, and it's in the September quarter. So do we have any insight into what's going out there? So we had a 13% increase over the last year, but we're seeing they're going to be relooked at in the coming quarter, and I think they say that they revise it. Is that right? Do we have any insight into that?
I think, anecdotally, it seems like council rates will be another driver in the September quarter, so we could see quite another strong lift in council rates, which just, again, keeps domestic inflation higher.
We're all getting our notices now. So we've got our CVs a couple of weeks back from memory, and now we're getting our new rates bill sort of feeding through.
How's it looking?
It's not deflationary, I can say that much.
Oh, man. But yeah, that's another reason why that September quarter, this 2.7% probably isn't the peak just yet.
Yeah. But, I mean, let's go back. You went into the lockup, went through all the data, and then you called me straight away, and I said, how is it looking? And you said it's actually looking, better than it could have been.
Yeah. We had, 2.8 on the year, came in at 2.7%. So it's better than when we expected. And looking at it, there is quite broad-based weakness.
Yeah.
And, you know, if we think about the whole CPI basket, or the goods and services within that, 35% actually recorded a decline in price. That's a bigger share than in the March quarter, which was 30%.
Yeah.
And actually the number of items that didn't increase in price was pretty much, you know, little change from the proportion in the previous quarter. So there is this broad-based weakness that's developing, which is what you'd expect with such a weak economy. So it seems like the reasons for the increase in inflation this time around are very temporary. I'm kind of hesitant to say that word coming off, you know, COVID times, and there was this transitory, persistent kind of debate happening. But it does seem like it's temporary, and the weakness in the economy should see that inflation in the medium term return to 2%.
Yeah, and that's the key. I mean, anyone reading the report in the news is going to say, oh my God, you know, 2.7% and food prices are up massively, you know, and they sort of put their heads down and go, this is not good. Well, actually, it's not as bad as we thought. There's a lot of, I think, disinflation still working its way through the economy, and that's the main point, right? And you can see that in financial markets, right? The financial markets priced in more chance of rate cuts, right, on the back of this report. So clearly, the job of the Reserve Bank is not to, you know, lift interest rates every time food prices go up. It's actually to look through and, you know, what's our forecast for this time next year? I think that's a key message.
Yeah, it's around 2%, potentially below that.
No, it's not. It's below.
Potentially. Yeah, okay. 1.8 is what we have, because that is where the risks are skewed. It's skewed to the Reserve Bank undershooting its 2% target.
Yeah.
And last week on our episode, Jarrod, we talked a lot about, well, we were breaking down the Reserve Bank's July meeting, how they took a pause. And, you know, we were really saying we wouldn't have paused if it had been us. There was a lot of weakness in the economy. We understand that there's, you know, we very sympathise with the fact that, yes, inflation's moving in that bit higher. But we talked a lot about how weak things were on the ground in the housing market, in your manufacturing, your services. There's a lot of weak data coming out. We actually had a question come through after our podcast episode saying, you know, from their understanding, and if you look at the Reserve Bank's website, their only mandate, their only task is to target inflation. So, you know, why are we talking about this weakness in the economy, and why should they cut if there's this weakness, if inflation is rising, and if that's their, you know, only mandate? So, MJ, I'm throwing that question to you.
Why are we talking about? Yeah, well, it's this battle I think that's happening right now between these near-term inflation concerns and then weak growth, because this weak growth could actually translate into weaker inflation in the medium term, which is the horizon the Reserve Bank has the most influence over. And when that's kind of your outlook, that weak growth will turn into weak inflation, that's why we are concerned about, you know, keeping the cash rate low and pushing it into symmetry territory.
Yeah, I think there's two things I'd say. The first is that the Reserve Bank sets monetary policy today for where they believe the economy is going to be in 18 months' time on average, right? Roughly. So, you know, the temporary spike in inflation that we're talking about is something that we're dealing with over the next 6 months, but we're really interested in where that lands in, you know, 12 to 18 months' time. And given the recession we've had, given the weakness that's developing in the labour market, there's a lot of disinflation coming through. And as you say, we probably will get inflation below 2% next year. The other thing I would say in answer to that question, it's a good question, it's a fair question, they focus purely on inflation, yeah, but there's this beautiful thing called the Phillips curve that we like talking about every now and then. All central banks use it, and it's the relationship between inflation and, you know, labour market indicators like the unemployment rate or the underemployment rate. The idea being, as MJ said, you look at growth in the economy, you look at the strength or weakness in the labour market, that drives inflation. So if you're focused on inflation, you've got to have a good handle on what the economy's doing. I don't think they have had a good handle on what the economy's doing. and what the labour market's doing. And I think the labour market is worse and getting worse than what the Reserve Bank originally thought. So they haven't read that well, in my opinion, and we've got a cash rate which is too high, in my opinion.
Yeah. At this, keeping rates at restrictive levels or even maybe at neutral, you're risking further unnecessary damage to the labour market with your economy being so weak, potentially weakening further from here. That just lifts the unemployment rate further than what it needs to be to correct the whole economy.
I mean, let's just talk about an average household at the moment, right? What are you facing? Well, you face a massive spike in food and energy. That's a tax. That acts like a tax because you have to spend more on those essentials and less elsewhere, right? So that's hurting. You've probably lost hours, right? Worked hours are down 3% on the year, and the unemployment rate's rising. So if you've still got a job, you might be less secure, right? So that hurts confidence, and all of that feeds through.
Yeah, you're seeing it in consumer spending. We've had so many rate cuts. Interest rates have really fallen from their peaks, but consumer spending just has not reacted to that just yet. It's really been going sideways, even in discretionary spending, which is where you'd think that a bit of that would lift when you've got disposable incomes kind of increasing. Haven't seen that just yet. I think we do have this big wave of mortgage refixing coming in this half of the year, but we just have not seen signs really of a lift in consumer spending yet.
Interest rates have fallen, but they haven't fallen enough. They're not gaining traction yet.
Yeah, just really feeds into our, get rates to 2.5 story. I think
it does.
Talking a bit about the labour market kind of reminded me about the whole net migration story that we've got going on right now. And we're seeing that also have a feed-through effect onto prices, particularly in rents, right? So rents also, going back to the CPI inflation report out today, rents also continue to fall. What was it, the smallest increase since
2021?
Yeah. And that continues on a downtrend, right?
Yeah. Again, it's another interest rate kind of sensitive part of the CPI basket. And that's fallen 3.2%. It's no longer the high rates that we were seeing a couple of years ago. So that's really fallen off. It's just really those administered costs that are keeping domestic inflation, high on paper. Because actually, if you remove that housing group from non-tradables, if you kind of exclude those things, the trend is down.
I was just going to say it's those administrative costs that the Reserve Bank has the least influence over.
Yeah.
But again, if we look at all those parts that are interest rate sensitive, they're really weak.
So, we've talked about it from the viewpoint of households, right? It hurts and there's more pain, and, they're not spending on discretionary stuff, right? What about businesses? So, there's some good news in there that prices of certain things are easing. What are they saying? We had the QSBO out a couple of weeks ago. What are they saying around prices?
It's just, I guess, pointing to those just continued weakness in things that are driven by demand, because demand's been so weak. Those price impacts have been quite weak themselves. I guess if you're in the sort of transport business, it's good to see that petrol prices have fallen quite a bit, down I think 4.8% on the quarter, and that's despite the Israel-Iran conflict that happened during the quarter. So it didn't really seem like it had an impact on petrol prices. So that's I guess a good news story for those in that business. And construction, obviously they've had quite decent price declines there. I think the main takeaway for them is just that this CPI data, this inflation data, sets up a rate cut for the Reserve Bank.
It does.
In August. So that should be, we should see interest rates fall, at least stay quite low for a while.
Yeah. So the market is pricing in 75% chance of a rate cut in August, and they're not going to stop there. So I think the wholesale rates have, the cash rate drop into 2.8, which is, getting into the territory of pricing in 2.75, so a second move. And then we're sitting here saying 2.5. So there could be more interest rate relief, for everyone, households and businesses. All right, well, that's all we have time for today. Thanks for tuning in. What do we got? We've got high inflation here and now, but it's heading in the right direction. So this time next year, inflationary pressures will be much lower, interest rates will be much lower, and growth, we hope, will be much higher.
Make sure to like, follow, and subscribe. And also, we have been receiving a couple of questions to our email, and we thought it might not be super clear if you do have questions and want to send them through, where to send them to. So if you have any questions you want to flicker through and we can answer on the podcast, be sure to email those to kiwieconomics@kiwibank.co.nz.
Written here.
Cool. Catch you later. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwi Bank.